Hi everyone, it's James Murray, Chief Compliance Officer and Investment Advisor at Safeguard Investment Advisory Group. Is now a good time to invest? Or for those that are invested in the market, should I be getting out of the market? These are two questions we've heard over the years, and we typically hear them when markets are hitting or nearing an all-time high, or when markets are declining. So let's take a look at the emotional roller coaster that an investor will go on. As the markets are going up, we will start to hit what's called an all-time high or near an all-time high. And you will start to see headlines and articles about hitting an all-time high. In fact, these articles and headlines have been written 1,000 times in the past and will continue to be written 1,000 times in the future. It's interesting if you think about all the all-time highs the market has hit, and yet people will still ask, is now a good time to invest, or should we be getting out of the market? So investors will ask the question, is now a good time to invest? Because the thinking is, if the market is near an all-time high, markets are bound to start going down at some point. And let's say markets start to go down, and they're down a little bit. Once again, they'll ask the question, is now a good time to invest? So they ask that question, is now a good time to invest? And let's say the markets keep going down. And now we get down here, and the markets are down 10% or more. And once again, investors will ask the question, is now a good time to invest? Because the thought process is, well, if it's down 10%, it's bound to go down 15%. Or if it's down 15%, it's bound to go down 20%. So they ask that question, is now a good time to invest? So what I would like to do is give us some perspective on if we were to invest when the market was at an all-time high or after it had fallen 10% or more. So let's go out, if we were to invest after 1 year, 3 years, or 5 years after the market had hit an all-time high. After 1 year, your annualized return would be 13.7%. After 3 years, it would be 10.6%. And after 5 years, 10.2%. Now that's a decent annualized return. Now what if we were to go down to when the markets had fallen 10% or more, and we were to also go out 1 year, 3 years, and 5 years. So if you were to invest after the market had fallen 10% or more, after 1 year, the annualized return would be 11.4%. After 3 years, 10.3%. And after 5 years, 9.6%. It's interesting to me, if you look at both of these 5-year numbers, if you were to invest after the market had hit an all-time high, or if the market had fallen 10% or more, those 5-year returns start to become closer to the average annual return of the US stock market. Now, when people ask, is now a good time to invest or should I be pulling out of the market? Oftentimes, I think the good question to ask yourself is, if I'm not invested in the market, where is that money invested? And what's the annualized return of where it's invested? Oftentimes when I ask that question, the answer is it's in cash. And we know historically that cash isn't going to keep up historically with inflation, and that cash isn't going to keep up with the historical average rates of return of the US market. Now, just so everyone knows what data source I am using the S&P 500, and this is from 1926 through 2022. With all this being said, the main point is you want to make sure that you have an overall disciplined approach that has a plan that adds value to your overall situation and what's most important to you, your parameters, and your vision.